greetings to you if you're watching this asynchronously. Say that 3 times fast. And I'm recording this here in the 4th hand section. So if you have any questions, just let me know. What we're going to do today is to probably not finish chapter 8, but get close to it. So we'll pick up where we left off the other day, and let me go share my screen and we'll see exactly where that is. Here in the notes. And just to verify, those of you here in class, I had just covered the other day the high-low method. We left off with other possible cost relationships, correct? Okay, I thought so. Yes, so, after you've been teaching something for a long time, you know the information so well, and sometimes you can't quite remember where you left off. And I left off in different spots between my 2 sections and, well, just wanted to verify where I left off because it was so easy to omit a topic that way. You think in your mind that you've covered it, but you haven't in reality. So if you've ever had some bit of material the professor didn't cover and you're wondering why not, it's really best to ask. It probably slipped that professor's mind. Or sometimes it might be where the professor just plain old skips a section as he or she is teaching. That sure is easy to do as well. So, yeah, just double check. Sometimes students think professors know everything, but they don't. Well, here in E, we have a few other possible cost relationships here. So, up until now, we've been saying that all costs are either fixed or variable. And we're going to return to that after covering this little bit here, these 3 other possible cost relationships. Because in reality, in life, is everything either one way or the other? Is it always dichotomized? It's not. Instead, most things in life have some fuzziness in them. Some things that are just, well, we just can't classify into a few categories, especially into 2. So instead, we have to allow some, for some other possible exceptions, shall we say, to the general rule. So the general rule is that, yeah, costs are fixed or variable, but I don't want to say all costs are fixed or variable because there are exceptions to that. So here are 3 exceptions. We'll deal with them, they're easy, and then we'll go back to dichotomization again, where we have either variable or fixed costs, and that's it. So these costs, one is a mixed or semi-variable cost, has both fixed element and a variable element. Here go the lights. Well, total mixed cost equals total fixed cost plus total variable cost. However, these mixed costs are simply small costs out of the company's total costs that they've got. So this is just one cost, one small expense. For example, if we thought about electricity in the factory, we thought about the electric bill from Lakeland Electric. Well, we can have, we would normally say that the electric bill is a variable cost, and it mostly is. As our volume goes up, the bill goes up too because we use more and more kilowatt hours. However, if we think about it, with the electric bill, it's actually a mixed cost. First of all, there is a fixed monthly charge to maintain the hookup. Customer charge, it's called. And at home, I think it's like $11. Higher I know for business. So, okay, that element's fixed. So we can see even a home electric bill is a mixed cost. because we have that fixed cost element of the monthly charge. So even if we use 0 kilowatt hours, we're still stuck with it. Usually a good way to think about fixed costs is we're stuck. But then as we use more and more kilowatt hours, the electric bill goes up. So those kilowatt hours are representing a variable cost. So there's the variable cost component. And that electric bill is just one little piece of the household's total expenses. Now for a business, as well as for a household really, we would also have some fixed electricity usage, just as if we produce 0 volume, we would still be stuck with certain fixed usages of electricity, such as to maintain certain lighting, we move on all the time, such as to have a certain level of air conditioning in the factory at all times. So things like that would also be fixed. So yes, the electric bill always has a fixed cost component, a variable cost component. It is truly a mixed cost. However, we still usually say variable for electricity because the fixed cost elements are so small. Now, unless we just had some unusual circumstance in which fixed usage is really, really big. By the way, that's sometimes called a semi-variable cost. Picking up zero from and now go away. Yes. Now, number 2, we have a step cost. And these are fixed for small range of volume within the relevant range, but the increase in a step-like fashion as volume increases. Step costs have characteristics of both fixed and variable costs. This is making it rather difficult to analyze them in our earlier format. And the key is to narrowly define the relevant range. We're illustrated in the book, but I don't know why the book does not define it as such. It's kind of strange, but I can show you up here on the board. Let's say that we have some process. Okay, those of you online. So let's say that we have some process that needs more and more employees as volume goes up, or more and more machines as volume goes up. Let's see. We can have a dry cleaning business. How about that? So at this dry cleaners, one employee can process 50 shirts per day. And I can see how it would be labor intensive, especially if they're starched and pressed. And that worker costs $75, let's say. So let me flip the lights back on. And I'm going to go ahead and take the cable off so my camera will go off. And if that's something else, I think you'll probably see okay. If not, you need to put something up on the camera, just let you know. I'm going to move my computer over here. Just pushing the board space as always. So let's say that we have a dry cleaner. let's go ahead and say one employee costs $100, just so we have a nice round figure. So what would things look like? We're doing this graph per day. As always, dollars and volume. Volume would be number of shirts. So up to 50 shirts per day, you'll see why we have to narrowly define the relevant range here for a step cost function. So first of all, if we had 0 shirts processed per day, obviously we need how many employees? 0. How much does it cost each? 0, you betcha. Now, if we have from 1 to 50 shirts, how many employees do we need? 1. So at a cost of how much? $100. That's 100 right there. Well, for 1 to 50 shirts, we need this 1 employee. Cost $100 again. If we have from 51 to 100 shirts, well, how many employees do we need? 2. Yes. And that little relevant range here from 51 to 100 right there. And again, the total cost would be 200. Yeah, just 2 times $100 piece. If we got from 101 to 150 shirts, we now need how many employees? 3. Cost of how much? 300, you betcha. This little relevant range from 101 to 150 shirts per day is right there. Again, 3 employees at a cost of $300. And then on we go. So why is this called a step cost? Yeah, looks like stairs. Yeah, looks like steps. And if you have a whole bunch of these, you could kind of estimate that like a variable cost. You really could. But if you want to be technical about it and compute a more exact cost, you need to know which stair step you're on. So you define the relevant range very narrowly here, such as 101 shirts per day to 150 shirts per day. If you do, you will know that you need 3 employees at a cost of $300 in total. Yeah, which reminds me, I don't know if you saw it on online news the other day. There was a little girl, what was she, 5, I think, who was being held by her mother and biological father someplace in upstate New York, but they did not have custody of her. That they had kidnapped her from the custodial relative, like a grandmother or aunt or someone who was taking care of her. So police had searched the house where the parents were living and couldn't find any trace of the little girl. Well, finally they went back, and one of the investigators happened to see a blanket poking out of one of the steps, actually between the tread, as that's called, and the riser, which is what that is. So that part's the riser, that part's the tread. And saw this blanket. Goes here on these stairs. So poking out between the tread and the riser, this blanket, and the police there disassembled the stairs, and the little girl and her mother were hiding under there. It was down toward the bottom, and I don't know what was over here, but knowing how houses are built up north, that was probably the start of the first floor. So they found the little girl. It was one of the staircases up north that are thought is not very important, I guess, in the house when it was built. So the stairs went down into the basement, and there was no handrail. I always thought that was so dangerous. Anyone ever seen a staircase like that up north? Or from the first floor to upstairs, second floor, you often have a very narrow staircase that has no handrail. And above the staircase, there's a door that looks just like a closet door. So you open up the closet door, you'll walk up the steps, and they're on the second floor, which is usually not a full floor. It's usually referred to as a half story. You'll have a bedroom or two. And the ceiling slopes down underneath the slope of the roof, or roof. Now you say roof because you're not from parts of the country that do. I always thought that was so weird to have a staircase like that, and then somebody could fall. Especially dangerous down in the basement, because up north they tend to have the washer and dryer in the basement. So you have to carry clothes up and down these. Well, you can see why here in Florida, things have been simplified. One story for most houses, because retirees have had enough of staircases up north they had to climb. Okay, that's a step cost. So that's just one little type of other cost I wanted to show you. Just have a seat here. Since I don't have my computer at the podium, it's actually better to be not at the podium, I think. Ugh. Yeah, that big podium takes up so much space and gets in the way of everything. So podium over there. Also, we have all these tables right there in the front row that are all blocked by other tables, etc. So that's annoying as you're teaching in here. You can't very easily get out of the little area they've assigned you. Okay, so if I go back here to my notes, let's see the next possible cost relationship here. Well, what that's going to be, oh, I still have that, pardon me. So what that's going to be, number 3, a batch cost. Involves a sub cost for each batch of production or purchase or sales as our lights go out again. Therefore, total manufacturing costs equal total fixed cost plus total variable cost, then add in this batch cost, and it's easy. It will be the number of subs or batches times the cost per sub. So let's say that in this dry clean business, there's a cost to switch between starched and unstarched shirts. You know what starch is? Something like potatoes, exactly. So potatoes, corn, rice, all so-called starches, yes, because they contain a lot of the ingredient of starch. So from corn or wheat, starch is extracted to starch clothes, and it makes the clothes stiffer and less prone to wrinkle, and you can feel it. If a shirt is starched, it will definitely feel not as soft and flexible as an unstarched shirt. And you have to pay extra in dry cleaners to get the shirt starched. Okay. Because, well, it does cost money. And then maybe you've seen spray starch in a store or liquid starch. Oh, okay. Some people still use it. It's a pain to use, and it makes the cover on the ironing board really stiff too. Do people iron a lot these days? No, so no need for spray starch either. But in days past, yes, starching was a big thing and ironing was a big thing. But with today's materials, they don't wrinkle as easily for the most part. Used to be a shirt like this that I'm wearing would certainly be wrinkled coming out of the dryer. Then you have to iron it and starch it. The other thing is attitudes have changed, and if a shirt is slightly wrinkled, it's kind of like, yeah, so what? Well, if this dry cleaner switches between starched and unstarched shirts, there could be a cost to set up each batch. So with starching, we have to load starch containers on the great big press at the commercial press that we would press shirts on. They're not ironed by hand so much, but we would have to set the starch container there and get this press to spray the starch on as it does, and then clean afterward to go back to a batch of unstarched shirts. So definitely this setup or batch cost, switching between starched and unstarched shirts. So whatever that is, that batch cost, we would simply take the number of setups or batches and multiply by the cost per setup. So I can envision it being much in a dry cleaner, let's say $10 at the most, including labor. Well, if we had 50 batches that day, so switching between starched and unstarched 50 times, well, did I say 50 all the way through? Okay, so let's assume that we did have 50 batches here in a day. Again, switching between starched and unstarched shirts. Let's assume it costs $10 to switch. So if we have 500 batches, 50 batches. So if we have 50 batches and we multiply by this $10 per batch, we would come up with $500. Sorry, I made a posting error there a moment ago. So $500 as far as what's in parentheses here. We would add this $500 onto any other total fixed and total variable costs. So with me on that, I'm not really concerned that you calculate numbers here, but I just kind of want you to get the idea of what these costs are. All right. Well, the next thing I have for you here is the introduction of contribution margin. And in this case, we'll come back to some calculations. Let's also go back to where we assume that we have only variable costs and fixed costs. So the simplified dichotomized world. Let's see what this is. Well, in this chapter, we're going to be concerned with period costs or expenses. Just in setting this up. And also in the way of setup, the volume that we will examine is measured as the number of units sold. And we will assume this equals production volume, equals the number of units manufactured. So sales and production volumes are the same. We usually assume that unless we're told otherwise, just like a true just-in-time system. Thus, our usual revenue driver and expense driver will be the number of units sold. We always assume that. We will concentrate on the special case of one product rather than the usual case of a sales mix of different products for simplicity. So one product at a time. That gives us a really good background in which to gain knowledge. And then we can easily project that to multiple products, sales mix of multiple products. And if we do, it just means more calculations. So for this class and for managerial finance as well, one product at a time will do the trick. By the way, the information in this chapter, as I mentioned, will feed directly into managerial finance. They'll cover the same information, albeit a higher level, and also with greater breadth. So some more topics coming in that, well, greater depth and greater breadth too. So managerial kicks it up a notch, or managerial finance, I should say, kicks it up a notch for managerial accounting. By the way, reading that last line there, last sentence, in the special case of one product, unique break-even point can be computed. In the sales mix of different products, a unique break-even point cannot be computed. We would have to use something called linear programming, and we would find a feasible area of break-even points. But one product at a time, again, will do just fine for us. That is also just fine in a business that is analyzing their operations product by product, as they often do. So in B, as I mentioned, all expenses considered in this chapter will be either fixed or variable. So we went back to that assumption. Therefore, operating income is simply revenue minus variable expenses minus fixed expenses. And in C, we can prepare a firm's income statement on either a functional format, as you did in financial accounting, or on a contribution margin format. We'll do that in this class. You'll also do it in managerial finance, and it makes it a lot easier from the standpoint of analysis if we have this contribution margin format income statement. I will show you why. Well, note the operating income is the same on both formats, but gross profit or gross margin differs from the contribution margin. So we'll have one new figure on this, the contribution margin, on the contribution margin income statement, of course. So here's an example. The Lake City Lock Company produced and sold 2,000 locks last year, a mean sales price of $9 each. Variable manufacturing and upstream and downstream costs are $3 and $1 per unit, respectively. Total fixed manufacturing costs and upstream and downstream expenses are $2,500 and $1,500, respectively. I keep those small, so easier to work with. We are to prepare an income statement under both functional and contribution margin format. So you'll see how we really have the same income statement, but we're going to rearrange just a few things on it. Again, to make it easier from the standpoint of analysis. Let me show you that. And if I go over to Files on Canvas, and I pull up the chapter 20, Solutions to the Example Problems, I'm going to have some information here there about functional functional format and contribution margin format. Excuse me, I'll get a little drink here. All the wrong way. And for those of you here in class, I'm going to plug my computer back in so that I can project, bless you, this PDF solution, because a few things I want to point out on it. I thought I could plug in my cable here in black and white. Yes. Let the relight even before I go over there and switch it came back on. Okay. Okay, there. Came on my screen there. So if I share my screen there, for those of you online. So here on the PDF and solutions. All righty. So I've got the functional format first and the contribution margin format second. We're going to find not many changes. Very easy to do. Functional format, we all know that from 2111. And this is the format required by GAAP. So that's why they do it in there. So first of all, we have sales revenue up top. 2,000 locks, $9 a piece, 18,000. Then we subtract cost of goods sold. We could also say manufacturing costs because it consists of direct labor, direct materials, and overhead. Well, we've got two different types. If we really think about it, in the way of cost behavior, we've got variable manufacturing and fixed manufacturing. Variable manufacturing is 2,000 units at $3 each, 6,000. Fixed manufacturing is 2,500, giving us a total of $8,500 of cost of goods sold. By the way, whenever you see a spreadsheet like this, where we have some numbers in different columns, as we go to the left, we have more and more detail. As we go to the right, we have more and more in total. So details of cost of goods sold are variable and fixed. Here is the total, $8,500. If we subtract that from sales revenue, we're left with gross profit, or if you prefer gross margin, two terms are synonymous, of $9,500. Then the other function of costs would be as upstream and downstream costs, or more commonly on an income statement referred to as either operating expenses or selling and administrative expenses. But technically, they're all upstream and downstream costs because, well, they've been categorized as such on the value chain, and we know that for every value chain expense, it is truly an expense, because as soon as we spend $1 on that function, whatever it may be, like R&D or product design, it hits the income statement. It's expensed right away. So variable upstream and downstream, 2,000 units, $1 a piece, $2,000, and fixed upstream and downstream, $1,500. Again, plain old fixed, no matter how many units we sell. So those are $3,500 in total. Subtract that from gross profit or gross margin, we're left with operating income of $6,000. So very familiar. Again, GAAP requires it. The reason it gets this name as functional is because it separates costs according to function, either cost of goods sold or upstream and downstream. Okay, now go over to the contribution margin income statement. Looking at its format. We've got sales revenue again up top. Very same figure, 18,000. Then we've got variable expenses. So we will subtract expenses according to how they behave. They may be either variable costs or fixed costs. We do variable costs first. So variable expenses. Well, variable manufacturing is one of them. Same $6,000. Variable upstream and downstream is the second one, of course, $2,000. Giving us $8,000 of variable expenses. Subtract those from sales revenue, and we have total contribution margin of $10,000. So total contribution margin reflects the amount of sales revenue left over once we've covered our variable expenses. So at $18,000 that we sell right off the bat, $8,000 will be eaten up by variable expenses. The remaining $10,000 is left over as total contribution margin. Total contribution margin gets its name because it then contributes toward covering fixed expenses that we're stuck with and then providing for an income. So if we take that 10,000 and we subtract the fixed expenses, we've got fixed manufacturing of $2,500 and fixed upstream and downstream of $1,500. We saw those numbers again in the functional format. So that gives us $4,000 of fixed expenses. And if we subtract those from total contribution margin, we're left with operating income of $6,000. And again, that number is the same as back on the functional format. So we simply rearranged some things I said earlier. And we did substitute one new number, total contribution margin, for gross profit. So we simply switched things up a bit. So here's the contribution margin format. Well, it's better to use this from an analysis standpoint. And in fact, that's why we do so in managerial finance and managerial accounting. Let's look at total contribution margin and everything above. If we do all these things from sales revenue through variable expenses through total contribution margin will change as volume changes. Then we have this band of fixed expenses. They don't change as volume changes. But finally down here, operating income will change as volume changes. So it makes the analysis a lot easier, as we'll see. So any questions there about functional format or contribution margin format? Right? Then back here on the handout, ND, contribution margin ratio. Excuse me. It equals contribution margin divided by sales revenue. And as an example, let's compute the contribution margin ratio for the Lake City Lock Company on both a total dollar basis and on a unit basis. We'll note that we get the same answer both ways. While we're at, we will also do the variable cost ratio, which is total variable cost divided by sales volume. And also get is 1 minus the contribution margin ratio. So let's see what I'm talking about here with some numbers. Okay. Also, in order to get there to those two ratios, let me look back at C, because I really need something from here. All right, in C, we can prepare a firm's income statement on either a functional format, there are the lights again, as we did in financial accounting, or on a contribution margin format. Okay, just like we said. And we've noted the operating income is the same on both formats, but the gross profit and gross margin different. All right, we did that for the Lake City Law Company. Let me remember those numbers and come here to E. So I'll show you D, E, and F all in one fell swoop. Decided as I was teaching there that that's going to work out better. And sometimes as you teach, if you're flexible like that and listen to your instincts, it really does work out. Or sometimes it could flop. But trust me, this was not going to flop. I've been teaching this class for years and years. All right. So let's look at E actually first. I will get to D and E, D and F, pardon me, and show you those. So in E, changes in volume within the relevant range, again, will induce changes in operating income. And that's due to changes in total variable cost and changes in sales revenue. Well, as an example, let's prepare pro forma contribution margin income statements for the Lake City Law Company for 1,000, 2,000, and 3,000 units. By the way, does anybody know what pro forma means? No? Okay. It means as if. So as if we sold 1,000 units, as if we sold 2,000 units, as if we sold 3,000 units. Pro forma financial statements are sometimes used in business to illustrate what could happen, like what could happen at each of these volume levels, but businesses need to be very, very careful about using it and identifying them as pro formas only, because if they don't, some investors are going to say, oopsie, I thought that was the actual income statement in this case. And if the company's actual income is below the pro forma income, those investors might get very, very upset and try to demand money from the company. You were at fault for misleading us with the pro formas, and that's been done successfully in the past. Don't want to go there. Since then, there have been a lot of restrictions on business use of pro forma financials. By the way, if an investor doesn't think they've been misled, there will be an attorney out there to coach them to say, yes, indeed, I've been misled. You know, kind of like in a personal accident lawsuit. Here, wear this neck brace. And as we know, who creates more graduates? Law schools or accounting programs? Anybody know? Law schools. No. There's always a supply out there of lawyers to sue in our litigious society, meaning we like litigation. Morgan & Morgan, yes. Morgan & Morgan now claim to be the nation's largest law firm. Started off in Tampa. But they sure have grown very rapidly. So I guess if we are misled, we thought the pro forma income statement was actually the true income statement for the company. And of course, the pro forma income was more. Wow, now Morgan & Morgan are going to sue for us. Yeah, just like they will if we have an auto accident. And I haven't heard the advertisement lately, but there used to be one for, I forget the name of the law firm, where you called their number, it was 411 pain. Yeah. All righty. Taking a look here at these pro forma income statements. Again, if I look at the file that I referred you to on under Canvas files online, well, here's one thing that's on that. It's PDF of solutions to the example problems we use in class. Here are 3 pro forma columns, 1 per volume level. 2,000, I'm sorry, as if we sold 1,000 units, as if we sold 2,000 units, as if we sold 3,000 units. So again, a pro forma income statement, but with 3 possible volume levels. So what would happen at each? Then I filled in the blanks. So with sales revenue, $9 a unit. Multiplied by 1 unit, $9,000, 2 units, $18,000, 3 units, $27,000. Then to compute variable expenses, well, manufacturing is $3 per unit, upstream and downstream, $1 per unit. We're given those. So if we sell 1,000, we'll compute manufacturing and upstream and downstream expenses of 3,000 and 1,000 respectively. 2,000 units, $6,000 and $2,000, and 3,000 units, $9,000 and $3,000. So now simply subtracting those from sales revenue, if we sell 1,000 units, we expect to gain a total contribution margin of $5,000. 9,000 minus 3,000 minus 1,000. If we sell 2,000 units, we expect total contribution margin of 10,000. 27,000 units, I'm sorry, 3,000 units, we expect total contribution margin of $15,000. The other way that we come up with total contribution margin is by remembering that the selling price of these is $9. Therefore, contribution margin per unit would be that $9 minus variable expenses per unit. $3 of manufacturing, $1 of upstream and downstream. So our variable costs per unit are $4. Take the $9 price, subtract $4 per unit variable cost, and again, we're left with $5 as far as contribution margin per unit. Now to get total contribution margin, simply multiply by the number of units, such as 5 times 1,000 units gives us 3,000. Then subtract away the variable expenses. So we've got manufacturing of 2,500, upstream and downstream of 1,500. No changes all the way across those columns. That's because fixed expenses don't vary no matter what the volume level is. We're stuck with them. So now if we subtract, we get operating income of $1,000, $6,000, $11,000 respectively. Now, we can look at this and see why this contribution margin income statement is going to help us from the standpoint of analysis. So if we first look at total contribution margin and everything above, all these things change as volume changes. Come on down to this band of fixed expenses, which do not change as volume changes. Very easy to subtract them to get operating income. And by the way, this band of operating income, this row, does change as volume changes. So you can see standpoint of analysis looking at what happens as volume changes. What else changes? Well, what does not change? So sales revenue will change, the variable expenses will change, total contribution margin will change, operating income will change. However, fixed expenses do not. Okay, any questions there so far? All right. Those notes, okay. Now, as we look at the information we had under D in this section, that was about contribution margin. So we said that we could compute the contribution margin ratio on either a total dollar basis or on a unit basis. So let's say that we did that here from this income statement. It does not matter which column. So it does not depend upon sales volume. Let's say that we did it here for the second column, 2,000 units sold. Well, in the numerator, we bear in mind that we have total contribution margin. So total contribution margin, sure enough, $10,000 here. Divide that by the sales revenue, which is 18. So we do that here. We get in reduced fraction, 5/9. Or if you prefer in a proportion, 0.555 repeating decimal, as many decimals as you can get in as you'd like, really. So 5/9 or 0.555, or if you prefer a percentage, simply move that decimal place over 2 places to the right, and you'll get 55.5%. Well, that's saying that out of every sales dollar, we'll still be left with a bit over 55.5% as profit. It's what is not there that is eaten up by variable costs that we're really concerned with. We'll get into that ratio in a second. By the way, if we wanted to compute this on a unit basis, we already have the unit information. Contribution margin per unit effectively was $5. Then total revenue per unit, that selling price, in other words, would be $9 per unit. So if we divide 5 by 9, we get, well, just a bit over 55.5% again. 0.555 repeating decimal. There it is. So same thing. Unit basis or total dollar basis. What this is saying is that out of every sales dollar that we get, a bit over 55.5% is eaten up by variable costs, and the remainder, well, that would be 44.4 cents, 0.444, I should say, repeating decimal. That must have been eaten up by variable costs. Sure enough, it was. In fact, let's look at that variable cost ratio right down here. So variable cost ratio, here we go. I should say right over here. If we took total variable costs at any one of these volume levels on the pro forma income statement, let's say that I took it from the 2,000 unit column. Well, total variable costs, total variable expenses, pardon me, let me backtrack. Let's say that I took that from the 1,000 unit column. And oh, by the way, with the contribution margin ratio, I took these numbers from, let me just double check. I took these from the 2,000 unit column. Oh, does it matter which column? Nah, I get the same answer both ways, so don't panic. I like to show different things like that sometimes. Okay. So if I took these numbers from, these are coming from the 1,000 unit column. I've got total variable cost of $4,000, 3,000 and 1,000 right there. Total of 4,000. Then if I divide by sales revenue at that point, which is 9,000. Well, I get, if I reduce that fraction, 4/9, which is actually doing this on a per unit basis because variable costs per unit are 4. So 3 plus 1. And the sales revenue per unit, if you will, is the same thing as the price of $9. So 4/9, or if you prefer a decimal, 0.444444 on it goes, repeating decimal. Or if you prefer a percentage, 44.4%. All right, so let me bring you back live if you're online. And let me get the lights back on here. Okay, there it is. One good marker. So another thing that we could say about the variable cost ratio and the contribution margin ratio, they add up to 1. Just making sure that I get this in the right spot on the board to project on my camera. Yeah, it's really easy, if you're not paying attention to your camera, to write something on the board. Everybody who's live in class sees it, and anybody watching it remotely can't. Yeah, and since people are remote, well, especially if they're asynchronous, they just can't answer it. They just cannot ask a question to get an answer. Like, could you please move the camera? Now, a lot of people who are synchronous even don't like asking questions. They're shy about that. Okay. So if we've got the contribution margin ratio plus the variable cost ratio, they add up to 1. Here's why. They are complementary. So in this case, we have 0.555 plus 0.444 in decimals. They add up to 1. They're complementary. So this is saying that out of sales revenue, 55.5 cents, comes off like a haircut. There's contribution margin. Oh, oops, pardon me. This is saying, let me retrace my steps. Now, every sales dollar, 44.4 cents will come off the top like a haircut because that is covering variable costs. The remaining 55.5 cents is left over as contribution margin, again getting its name because with contribution margin, that is contributing toward covering variable costs and providing for a profit. Also, if you remember the common size income statement from back in chapter 15 on financial statement analysis, where we cast everything as percentage of sales revenue. Well, sales revenue is 100%. And on that type of income statement, variable costs would be 44.4%, and the contribution margin would be 55.5% of sales revenue once again. So it's either or. This is how we divide up or dichotomize sales revenue as we go down the income statement. That makes sense? I'll go back here to my notes. And some of this information here, I'm going to go ahead and skip. Share my screen if you're online. All right. So some information I will skip. If you want to look at this information here, right under our pro forma income statements, and also at the top of the next page here, 2 pages here per sheet, you can. It's a bit overkill for this class. I used to teach that in upper division cost accounting when I taught it, but it's probably a little bit of overkill, but I've included it anyway, just in case in the future you take upper division cost, or if you take managerial finance, it's also useful there. I used to teach it here in this class, but then I think, I don't know, that kind of went over people's heads. Plus, you didn't have to use it in homework here. So if you want to look at it, that's great. If you don't want to, I'm okay with that too. Yeah, by the way, this little calculation of the variable cost ratio, well, again, if we look under here, we see the variable cost ratio always equals 1 minus contribution margin ratio. 1 minus 5/9, sure enough, equals 4/9. Again, because the variable cost ratio and the contribution margin ratio are complementary. They add up to 1. Okay. Well, that's where I stopped my previous section, so I'm going to go ahead and stop there as well. I want to do that especially because I don't want to get in to the next section where I have break-even analysis and also profit planning going on and have to break in the middle of it. It's best to do that all in one fell swoop. It just makes more sense, as a lot of topics do. I realize that puts us just a bit behind it on the chapter, but not to worry, because I'm going to adjust my accounting lab deadlines, and we've still got plenty of time in the class. I've got lots of slack time left over toward the end, so I don't worry about it if I get a bit behind. I would much rather teach you something thoroughly, especially something important like this chapter, than to rush through just to continue to meet the syllabus schedule. So it's normal to fall behind in classes. Very normal. How many of you like rushing? Yeah. Oh, Russian. Oh, that's not such a popular term today, thanks to Putin. Again, I feel sorry for individual Russians, many of whom are extremely nice people. But unfortunately, their government, not so good. No. Same thing with Cuba. Oh, wonderful, wonderful people. Such a good government. If you ever go to Cuba one day, you'll see that in person. All right. Well, that's what I've got for you today. So please let me know if you have any questions. And other than that, have a great weekend. So good Shabbos too. My rabbi emailed me asking me to come to services on Saturday. Yeah, there's something special going on. Okay, well, I'm supposed to be here at Florida Southern, then event too. But if I were truly practicing all 613 mitzvot, which are the commandments, on the Sabbath, I would be Forma, this is called, and I wouldn't be working. Ooh. So we'll see how this pans out. Hey, the rabbi doesn't pay me, Florida Southern does. I'm not that observant, so I'll chase dollars instead. Not they pay me extra to come here on Saturday. No, I'm not paying a wage. I'm paying a salary. But glad to do it to help keep enrollment up. All right. So again, have a great weekend. See you back on Tuesday.